but we're still in positioning mode, and I just think that as we approach those levels, you'll see an accelerant be thrown into it, and so I'm not quite exactly sure where the level is, but you'll start to see us ramping up into those levels. That's when it starts to get very, very interesting, and I would expect that certainly will be next year. Now, whether that's in Q1 or 2, 3, or 4, whatever I suggest will certainly be wrong. So I'm not going to even offer up which quarter I think that we'll see that. But what I do think is the inflation is absolutely going to get worse. We know the supply chain problems are bigger than people are talking about. Like I said, the Vancouver one is quite alarming, and it feels like just a really cheap suit, and it's falling apart now. The whole supply chain was built on a just-in-time model, and just a fiat model, and it's just completely falling apart. Whether coincidentally or by design, by the way, but it certainly looks pretty ropey, and I think that loss of purchasing power is going to accelerate, so that should aid investors in our space.
On behalf of SDBullion.com, this is James Anderson. We're about to speak with precious metals expert Ned Naylor-Leyland, the head of the gold silver desk at Jupiter Funds. This interview was recorded yesterday, November 22nd, 2021, a day prior to today's spot price takedowns in both silver and gold. We'll jump into that interview in a few moments. For those of you out there who are waiting for Black Friday deals at SDBullion.com, be sure to get your 1-ounce silver round at spot price deal before it runs out, as well as some of the other promotions we're running on our bullion product offerings. Before we go further though, if you'd like this content, be sure to smash the like button and subscribe to our SD Bullion YouTube channel so you get our latest market updates and content. Hello there, this is James Anderson on behalf of SDBullion.com. I am pleased and thrilled to have today with us Ned Naylor-Leland. He's the head of the gold and silver desk at Jupiter Funds. Ned, thanks so much for coming on today.
Yeah, it's an absolute pleasure. Nice to see you.
Good to see you, of course. The last time we spoke, I had to look it up on a podcast specific to silver and gold's coming mania phase. It was in September of 2018. The silver spot price was at $14.22 an ounce. Gold was just below $1,200 an ounce. Jerome Powell was about to get in as the chair of the Federal Reserve, and SD Bullion specifically, we were running a sale on silver Austrian Philharmonic coins at only $1.15 per troy ounce over spot. So, and that was, I think, the most razor thin we ever sold in any type of sovereign silver coin. So it just kind of contextualizes, our relationship over these years. And the fact that the last time we did speak, it was about as bad as it's ever been in terms of our industry in the bullion section. We were fighting over market share. I'm sure you were doing the very same at your institutions. So let's just speak to the fact of where we've been, maybe on the news of the day, the fact that Jerome Powell has been reappointed for 4 more years. Lael Brainard is the vice chair now. What are your thoughts on how things are going at the Fiat Federal Reserve?
Well, I mean, it's funny to talk to you today. Obviously, we didn't tee this up in the last 5 minutes, but it was amusing that just before we came on this morning, I actually was quite excited, and thought maybe we would get Brainard announced. And of course, in fact, the guys on the fixed interest desk were like, "Let's go home early so we can come around here and start shouting." I'll be honest, it's just a bit weird, the fact that we can be upset or disappointed by Powell in light of the policies that have been applied, and therefore, as you say, the reaction is, of course, a direct function of those Fed policies. One should be happy to see more of the same as a gold and silver investor, but I suppose with the Democrats in charge and the MMT direction of travel, which we probably discussed 3 years ago, it felt like it was a moment where potentially we could see an acceleration of the gold and silver price based on real interest rates dropping if she got the job. It is a bit of a disappointment, but you know what? Things always take longer than you think. And I still think that things look pretty good for next year.
Mm-hmm. So given that effectively we really do have MMT in action, I mean, the balance sheet of the Federal Reserve has more than doubled since Jerome Powell got in. I mean, how big do you think the Federal Reserve's balance sheet is going to be by the time he leaves 4 years from now? I mean, we're at 8.75 roughly trillion. I mean, is it going to be double? Are we going to be near 17 trillion by the time he leaves?
Well, I would think, and the rest. I mean, ultimately, one wants to be careful getting involved in projections that far out, because we could be in a new system by then. I mean, like I just said, and I'll repeat myself endlessly as I always do, but we are always miles early, and I get to see that daily because I speak to people who are very much to the view that things are pretty much still fine. So all I ever see is just a marginal erosion in that confidence. But I would think what you said is perfectly reasonable, although of course the truth of it is that it's more like a parabola. So there's probably when we do get the next accelerated phase of balance sheet expansion, it will probably be multiples rather than a double.
Given how large and consistent inflation has been, I mean, I always operate under the thesis that the Federal Reserve essentially has to go the inflationary route, because that's typically what governments do. I don't expect they're going to outright default on the record debt levels and the unfunded liabilities that are estimated over 100 trillion to 200 trillion in net present value. I got to assume that they're going for the fiat CBDC system. Most nations, the 100 largest economies essentially are doing that for their own sovereign control, and they all want their own fiat CBDC, it seems. Do you think by 2026 we'll have the fiat Fed coin in action?
Definitely by then, yeah. I think that seems a long way out from here.
Right.
I just don't think that they can continue with these policies which are just destroying purchasing power now at an accelerated rate for another 4 years. I mean, I think that we'll have the reset before that. Some interesting context. I've been out on the road with some of my colleagues in the last couple of weeks and making jokes against myself, as us gold and silver investors have to do in public, and making the comment that when I first met them 6 years ago, I was saying that there's a reset imminent, and they all laughed and thought I was completely nuts. And probably they still do, but I did make the point that they would also say that they have heard that word more frequently than they would have anticipated hearing it. So I think we sit at a clear potential acceleration point for all of this, and I think that the inflation is the thing. I mean, ultimately, you and I both know that it's not about inflation. It's about the relationship between inflation and the ability to raise rates. That's really what moves it. But in terms of narrative and the ability to speak about this with more people, the inflation side of it is really warming people up to the topic and making them more interested.
I know here in the United States, we use the pre-1980 hedonic, they've obviously changed the way they do CPI, but I mean, we're roughly at 15% per annum, it seems like right now, for inflation and real inflation. What is it like over there on your side? What's it like in the UK? How is the inflation going? Is it around that percentage, do you feel?
I would say it's very similar. I mean, there's a surprising difference between what we're reporting and what the US are reporting, but I don't think that there's much to be read into that. And actually, what you say about the unadjusted data and shadow stats, I think it's quite interesting that we're starting to see propaganda pushback on it in the mainstream, which I think is very meaningful. It was that thing about they laugh at you and then blah, 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 and eventually you win. We seem to be in no, this is all rubbish. This is the reason why, which is definitely a change from where we were before. Before it was just like, what? What are you talking about? This is just nonsense. But it appears now there's an attempt to fight back. But I think that probably the key variable from what I see here is electricity prices. So I think that, obviously in the US, what you put in your car, I think, is extra sensitive. But we seem to be in a pretty much out of control environment now for electricity costs and gas costs. Okay, so the next 12 months will be very interesting to see how much the government let that feed through to people's bills versus how much the government have to absorb, because the energy providers are all going bust one by one now. They're literally just falling over and getting nationalized. And so effectively, they're going to have to pass it on. Now, I think that that's going to be very, very important. And will make people more aware of the true cost of living. I'm all in investing in sound money, but I'm not looking forward to seeing what that looks like next year. So those people who don't necessarily understand the macro well or aren't hedged for it, I think that's going to be a big driver of behavioral change.
So speaking to behavioral change, obviously in 2018, nobody wanted to hear it. Now in 2021, people are more receptive to it. How are the flows? What's the interest like in the institutional world. I mean, when we look at silver and gold on the retail side, I constantly remind people on our video channel, it is the large money flows that are going to make the difference here. And when they start to move, that will probably really move the prices and the values for silver and gold to the upside. So how have they been of late? Could you speak to it?
So personally, we've had a good year. We've had a very sort of strong year in terms of actual genuine realized interest. The marginal interest in terms of meetings and wanting to understand the macro has certainly picked up too. But I would say that set against that is what you see visibly on the screen, which is the flows in and out of the passive vehicles. So, we saw last year, what was it, May through September, a lot of money institutionally came into GDX from the hedge funds. So this isn't really what my clients, my world isn't like that. But it's very interesting to see that levered investment through the biggest passive vehicles was very apparent. It disappeared very, very quickly in Q4 last year, and it hasn't come back. Mm-hmm. So that's still to come. Retail, which I tend to look at as being more influential, and it's the silver miner ETFs, the passives there. They hung on a lot longer, capitulated in June, July, and still haven't come back either. So what you've got is a strange kind of contradiction, which is those people that haven't got in at all and are 1 times long, sticky money, definitely interested, and yes, some flows, but those other sort of institutional categories that one looks at are unpopulated right now. But the way I would explain that, and it's sad to say, but I think it's true, is, well, this is what I say when I go out pitching, is this is a 50-year cup and handle, as everybody on your channel knows full well, and most people won't join until it's broken out. So we're just in an odd positioning moment here, really, and whether one looks at Michael Oliver's momentum structure analysis or pure price action or whatever it is you want to look at, that's not the point. The point is that until the broader long only market feels like it's a breakout, then I think what you're going to get is continue to get a few early birds getting up and grabbing the worm. But really what we need some kind of breakdown in the real interest rate complex, which is why it's interesting to talk to you today with the announcement of the Fed chair, because had Brainard got the job, my opinion is you would have seen it all in one go. I think it would have happened, all would have happened today. We'd have just gone bong like that. Because what would have happened is the bond market would have realized that this is a rug pull on the tightening narrative. The tightening narrative would have basically been, that doesn't seem so reasonable now. But obviously with Powell keeping the job, they can maintain that narrative, which means we're still stuck below the breakout level. Right. But it's certainly not going to take several years from here. It's a case of what will be the catalyst. Will it be more inflation, or will it be some form of walk back on the tightening methods? And when I say tightening, by the way, of course, I mean both taper and rate hikes.
Just to think about it out loud, I mean, the Federal Reserve reports 8.75 trillion as their balance sheet, but Lord knows what's going on with special purpose vehicles and how many other plates they have spinning offshore. I sometimes take their data with a grain of salt, and I wonder if they are literally monetizing the bond market. How many people don't realize what's probably going on offshore, off balance sheet. So only the New York Federal Reserve and those at the top would probably know. So we would just be guessing if we tried that now. But I think that's something that people need to think of as well. People always constantly bring up the velocity of fiat currency, and the velocity of fiat currency is obviously at the floor because they've blown out all the monetary based measurements. I mean, M1, M2, I mean, they redefined what M1 is. So obviously if you create a denominator that's much larger, it's going to make the velocity in terms of the mathematics go down. So people, I think, are not taking into account the fact that, consumer spending in the United States is up plus 24%, and it's obviously trying to take up for what was lost during the COVID era, but this seems persistently high and it's going to stay that way. And if that's the case, you may have velocity of currency turning over a lot faster and psychologically people raising prices a lot more than one might think. I mean, that is the narrative right now, no? In the financial world is that inflation is here and, prices are rising. And what you get all of a sudden is something that kind of feeds on itself now.
Well, I'm not sure I agree with you.
Okay.
So I think this is potentially the sort of most value I can have here, is to make the point that while everything you say is true, I don't think that's what, it's a bit like correlation versus causation.
Right.
That's fine. All that matters is what my colleagues downstairs think about bond investing.
Mm-hmm.
Now, I don't want that to be the case, but this is what moves the needle for us. It's very much about the cash fixed interest market and their perspective. So we talk about SPVs or what they're really up to.
Yeah.
Most don't care. They're not interested. No, they're not interested. They don't care. In fact, they actively want to not know about that. So, while you might be right, and in fact you are, and we agree about everything, it's not the point. And also not the point for the average Joe either. That's the thing to understand. It's what matters is the bond market. This is what drives the speed and timing of our pretty much locked in outcome. It's at what point their portfolio moves around. So let's be clear. No point are these bond investors going to run from the building, their hands above their heads going, it's on fire. We do that. They're not going to do that. They're going to go, it's fine for the following 8 reasons. And you look at them and you're like, you sure about that? And of course, the answer is not really, but I'm not going to just, cut my own throat because it's obvious. I've got a job, I've got to beat peer group, which of course is what drives everything. So it's not about reality. It's about how do I compete in the fixed interest space versus my peer group for the next 6 months. And it's not by taking outlandish, albeit correct views about the medium to long term. So therefore, what matters for us really over and above everything is not velocity of money or what the Fed's up to. It's where and why does the bond market become more dovish than it is right now? Now that, as we discussed, could be, well, not dovish, but really interest rate negative. So that could be inflation is way worse than we realize. I'm dubious, they don't seem to want to understand that either. So therefore, that takes us to the tightening narrative. And what's priced in at the moment is that taper's here and it's not going. It's going to stay and it will roll out. And that the rate hikes are here. Indeed, they just got dragged forward by 1 month this afternoon, apparently. So therefore, what will stop those two things dominating the view of the fixed interest investor? And it would be policy error or shifting of guidance. Now, the shifting of guidance could be political. So, that's a possibility too. But I just say that what I've learned in 20 years is we can talk about all the other stuff and we all like it. And it's all very interesting and relevant to us. But in terms of price action, it's a narrower set of things that really make a difference.
Obviously, gold and silver miners are pretty cheap, especially compared to bullion. I mean, I look at charts sometimes, especially on the gold side. Bullion pretty much got outperformed by miners in the 2000s, but then the 2010s during that cyclical bear, bullion outperformed gold miners. Gold miners obviously got hit very, very hard. How cheap are they right now? How unloved are the gold and silver miners at the moment?
So look, on an individual case basis, as a team, we obviously look at everything in our unit. We look at quite a narrow universe, but within that, we've got to justify why we might own one stock other than another. And usually you look at net asset value or cash flow multiples as being the way in which you would make those judgment calls. And yes, they're cheap on a backward-looking basis, but that's again not really that relevant in the broader scheme of things. It's about the direction of travel and costs. So the reason why the miners performed so poorly for a long period is because even when gold was going sideways between 2013, 2016, and the miners went down 35-40% while gold is flat, its costs are the point. So they're trading cheap. Their balance sheets are way better than they were. So the nuclear winter they went through led to change in behavior at management and board level. So what you find is now that they're more cautiously run, better balance sheets, cheap valuation multiples. But ultimately, what we still need is flow, is participation. That's the thing that really makes these things move. It's not so much whether they have individually a better setup or valuation metric than was the case before. It's about, where we look at some things, I won't suggest what, and it's a greater fool. Here, it's a case of, are more people going to participate in this form of hedging or not. And yes, sure, I've got stocks that are high quality development assets on our model of trading at 0.4 times NAV, and that's really, really silly. But you know what? Let's say we went sideways in spot prices for the next 2 years, they're going to stay there or get cheaper. Yeah. So again, we don't get too hung up on valuation.
So, I mean, just to speak to the commodity complex in general, I'm sure you probably saw the clip of Paul Tudor Jones maybe 5 months ago or so, was on CNBC talking about, how little is allocated currently in the commodity index, and how little it takes for flows to come in to make it double, triple in value quickly. I'm looking at 1 year performance here. We got oats at over 148%, coffee's up almost 100%. Gasoline, 91%, heating oil, 80%. I mean, you're talking about the energies, right? Natural gas, 80%, soybean oil up 50%, cotton up 58%. I mean, all these various general commodities are up. Obviously, gold and silver have been trading sideways, consolidating after that run in 2020. I'm sure that's built to frustration of gold and silver investors to see other general commodities ramping up in price, and yet gold and silver seem artificially kind of sideways action the last year or two. What is it do you think is going to actually make silver and gold really, really move and actually get that confidence of the momentum flows into it? What is going to make that thing break? What is going to make it pop and continue on in this secular bull market that we think gold is in?
So as unfortunately, they're not commodities. So what's happening here is there's a conflating of things. Now, I think this will work in our favor quite soon, actually. It's true that a number of these commodities have done very well. My personal perspective is inflation gets hotter here. And, you look at, for example, what's going on in Vancouver at the moment, where a third of Canadian exports have now gone the way of the dodo because of rail and road landslides. And none of this is being reported, and supply chain problems are getting worse and worse. So actually, I expect commodities to become a kind of speculative sizzle fairly soon. Quite sure exactly what the trigger will be, but I think that what you'll find is a lot of people who are day trading, and there are a lot more speculators now than there were before, is they're going to be very attracted to the extreme volatility. It seems to be what people like now. They want to lose their entire portfolio in 3 hours rather than 3 years. So I think that what will happen is leaving aside the past moves, the depth of the futures and options market in commodities will be very attractive and interesting to the speculative community, and that you'll see that. And then what will happen is they will fail to understand that gold and silver are money, not commodities. And they will find that these two are, amongst the most liquid instruments they can trade in. So I think that probably will end up being a benefit rather than what it is at the moment, which is an impediment. But of course, the real reason is those are supply demand driven commodities, and of course, unfortunately, we're monetary metals trading in foreign exchange markets, where, as I say, the drivers are real rates, not underlying supply demand factors.
Well, speaking to the underlying supply demand factors, I presume you saw India's return finally to the silver demand equation. I mean, they were pandemic asleep for 1.5 years. They're pretty much offline in terms of silver demand. They imported over 50 million ounces in September, October 2021. I'm sure you recall back to February 2021 when consultancy Metals Focus, based out of London, essentially described the fact that London float in the silver warehouse unsecured ETF inventory levels were down to mere 100 million ounces roughly in terms of float, meaning that if demand had kept up, they may have ran out of silver and had to gone out into the open market and bid it up, and that would probably have driven the spot prices much higher. Obviously, you see this India's return. I would assume they're going to keep going and keep coming at a pace. I mean, they have a lot to make up if the demand is if they're trying to make up for demand that was lost last year, 1.5 years. If they keep up these kind of rates, you may end up with a situation where, if Western investor demand returns, India is moving on as robustly as it is. I mean, that is a recipe for a great 2022. My suggestion, my belief is that exactly what we're walking into. But what do you think in those terms? I mean, those are two fundamental drivers that may push a squeeze in terms of the physical market. But maybe there's something else that you're thinking.
Well, no, I think it's very relevant what you mentioned, but I would say that if you think about that number relative to what SLV purported to add in 3 trading days, that in fact it's generalist desire in the on rails financial world to have 1 or 2% in physical silver is a more powerful and overwhelming factor. I agree. You keep doing what they're doing at the moment, then one would expect this to have an effect. But I think I would probably respond by saying what I said earlier. Really, until gold's broken out and silver's through 30, and I tend to think silver won't get through 30 until gold's broken out. This is all jostling, and we'll see the whites of everyone's eyes, including the Indians and the one-time long investment community, all very quickly once we're in clear water. So look, I think it's good. We all know silver demand. I mean, just that one claim from the US that they can have, what was it, 40% of all power from solar by 2050. I mean, this is just
insane.
It's silly. None of this makes any sense. So really, we're still in the twilight zone. Let's get through those levels, and then we'll see. Then it's come on. Well, how badly do you actually want it, Mark? And then I think we'll know more.
So what do you think Q4 is looking like in terms of M&A pickup? Is there any merger and acquisition going on in the mining sector? Is it looking attractive or more so than it once was?
Well, I think that what we definitely have seen is an increase in activity. There's a number of deals that are happening. In fact, I would say more or less every day we're waking up to something, often in Australia, but sometimes in US and Canada. And it feels like the mid caps are now at the point at which they're actually wanting to move for fear of being left behind, which is interesting. I don't expect the majors to do much until generalists force them to. So there's an absolutely incorrect narrative out there that's been there for a long time, 10 years now, that at the peak of the cycle last time, management all made abysmal decisions and bought marginal assets, using debt and la la la. But what they're ignoring or probably aren't aware of is that's not how it works. What happens is the biggest companies, it's management by committee. It's the fear of doing things or not doing things that actually makes those decisions happen. And when you get generalist investors who don't own gold and silver mining stocks do start to own them, their influence is quite substantial. And the banks, combined with those new generalist longs, drive the behavioral change in the major mining companies. So you'll see exactly the same thing. We'll get through and gone, and then they'll start to do it. But yeah, we've seen Kirkland Lake Agnico is a very interesting transaction that creates a sort of quality name in the space that wasn't there before. But we're seeing a number of maneuvers going on now that suggest that more thoughtful management teams have seen the shift in the last 2 months and have said, you know what, this looks like we're probably back now, so let's move. We've seen a lot more activity in the last 2 to 3 months than the previous 12.
And what do you think? Is there any shift in terms of institutional investors in the perspective regarding like inflation of late? I would assume that their confidence is to be waning a bit, given how rampant inflation has been over the last 12 months or so.
Yes, but I think that I'm not sure that they don't frame it the same way that we do. So it's, the big money likes to be told what to do. It's not about having independent thinking. It's just not, look at the biggest companies in the world now. Look at what they are and what their valuations are. And, it's about groupthink.
Yeah.
So while, yes, people are more worried about inflation, I don't think they necessarily know what they're supposed to do about it, is the first. I think also there's an underlying belief, which is probably true, that having more in equities versus fixed interest or cash assists you in avoiding the issue. And of course, ever since QE started, investors all around the world have been slowly eroding their cash and bond part of their portfolio and buying more equities. So I think possibly they feel unreasonably confident about the way they're positioned.
Right.
Ultimately, if the Fed says the inflation is here and it's high, and it might go a bit higher, but it's going to disappear, then that's going to be their standing assumption. So they're not going to panic too much. Speaking
to the disappearing, I assume it will disappear at some point because we're going to have a deflationary bust. Maybe some major banks or something will fail. And that could lead to that reset thing that we've discussed a little bit about just generally. I mean, what in terms of, that potentiality, that happening, I mean, that exists. I would assume that you agree. The response mechanism, though, of just returning right back to the kind of answers that we did when the pandemic hit or when 2008 hit, which is essentially more QE, infinite QE, use SPVs to buy out virtually everything and make everyone whole. No one can fail. I mean, is that going to work again, or is confidence just going to further erode? I mean, ultimately, we've talked about it before. Gold and silver, to get in that manic phase, you need to get to that point where the currency in your pocket is burning and the person wants to get out no matter what, and they want to get into gold and silver, and that will bring the flow that would really drive values much higher.
That's most people's assumption would be, yes, more bailing, more. I mean, it's not my personal assumption, really. I think it's much less likely actually than a kind of beat you over the head with a baseball bat and then offer you a lollipop on the floor, which is more likely. If you want to maintain control, that's a much better way of going about things than allowing a sort of a riotous several-year race to the bottom.
Right.
So I tend to be of the view that the reports about the G20 meeting in 2016 and that they've written into law that they will not bail out, it makes much more sense to me that that's the case. Apart from anything else, the market's always wrong. The majority is always wrong. And the majority isn't seeing what I just said as even remotely likely to be an outcome, despite the fact that apparently they wrote this into law at the G20.
Right.
So I don't know that. I think it'll be much more likely to be, an event. And then in the UK for decades, we had these sort of silly cookery programs whereby you would sort of make something and then it would need to go in the oven. So they'd have one, here's one I made earlier, and they'd pull it out and it's sort of ready cooked. That's how I see this happening. But, either way, it still involves gold repricing, gold being the risk-free, repricing the government issued credit. Just it would be in one move rather than rolling over several years. Ultimately, that's all gold ever does anyway, isn't it? Is just repricing the promises of governments. And I think it can just as easily happen in one move as it would over several years.
So to finish it up, Ned, and I appreciate you coming on today, I wanted to get your feel for what you think next year, 2022, is going to look like for the silver and gold markets in general.
Well, I think that the trick is I know it's easy to say, and look, I'm 20 years in like you, but be patient, because getting people to capitulate on their worldview isn't necessarily, the easiest thing. And I don't think until we break out through the previous highs that you're going to see them, you won't see the monster move until that happens. So it's about recognizing that it's not happening tomorrow. I mean, unless we move through 2100 tomorrow, and then fine. But we're still in positioning mode, and I just think that as we approach those levels, you'll see an accelerant be thrown into it, and so I'm not quite exactly sure where the level is, but you'll start to see us ramping up into those levels. That's when it starts to get very, very interesting, and I would expect that certainly will be next year. Now, whether that's in Q1 or 2, 3, or 4. Whatever I suggest will certainly be wrong, so I'm not going to even offer up which quarter I think that we'll see that. But what I do think is the inflation is absolutely going to get worse. We know the supply chain problems are bigger than people are talking about. Like I said, the Vancouver one is quite alarming, and it feels like just a really cheap suit, and it's falling apart now. The whole supply chain was built on a just-in-time model, and just a fiat model, and it's just completely falling apart, whether coincidentally or by design, by the way. But it certainly looks pretty ropey, and I think that loss of purchasing power is going to accelerate. So that should aid investors in our space.
Well, Ned Naylor-Leland, thanks so much for coming on today to speak with us, and really do appreciate you taking the time and giving us an update on the institutional view, what's going on over there in the United Kingdom. Appreciate it.
Always an absolute pleasure. Let's not make it 3 years next time.
All right, Ned, I promise you that. We'll do it quicker. Cheers, mate.
If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content.